Hello and welcome to Sectors Up Close. I'm Emma McCarthy. Our focus today is on US banking stocks, and our guest is Amy Kong, the Chief Investment Officer at Barrett Asset Management. Omicron's arrival has hit banks hard. The S&P 500 banking index has lost 7% in the last 5 days to Wednesday, more than double the losses in the wider S&P 500. The drop has been attributed to fears of the economic impact of the new variant, as well as the sudden drop in Treasury yields the news precipitated. But longer term, banks and banking stocks have been in limbo for the past few months, trapped between high inflation eroding its fixed income assets and potentially higher interest rates as the Fed winds down asset purchases. This has meant that while investors saw gains of 30% this year, these stocks haven't moved much since May, and valuations in the sector remain historically low. So what is the outlook for this sector? Let's ask Barrett Asset Management's Amy Kong. Amy, thank you for joining me. Let's start with Omicron then. There's been a huge sell-off this week. Why do you think that the banks reacted worse than other sectors?
Hi, good morning. Thanks for having me. I think the banks have reacted more than the general market, really because of the shape of the yield curve. To your point, the Omicron virus is a big unknown at this point. We're still trying to understand how contagious this virus is. And as a reaction, the markets have really sought safety. We saw that in the last couple of trading sessions, which to your point has really pushed down the yield curve. The 10-year, as a case in point, was as high as 1.65% before the announcement and has dropped about 16% to 1.4% today. I'm not surprised to see the banking sector underperform in this kind of market, just again, given the correlation between the banking stocks and the yield curve. Clearly, a flatter yield curve does not bode well for net interest income or net interest margin. So that partially explains why the banking stocks have unfortunately fell out of favor over the past couple of days.
In terms of valuations, Amy, would you say that the sector is undervalued?
No, I think it's fairly valued at this point. I recognize that the price to earnings ratio is typically lower, but when you look at price to book value, which is another metric that we use to evaluate the sector, depending on the bank that you're dealing with, we're looking at between one times to as high as 1.5 times, and that's very much in sync with normal ranges. So I think at this point, in terms of what's being baked into the stock prices, using Fed futures as an example, the market thinks that there's going to be 4 rate hikes between now and the end of 2023, 2 next year and likely 2 or more in 2023. And so at this point, if we start to see Fed language start to shift, and that's obviously data dependent, if they start to pivot in such a way that pushes the interest rate hikes sooner, then I think the banks could have a little bit more upside from today's levels. But certainly, depending on the variant that we're now talking about, it could slow things down again. So the angle at which the Fed pivots is certainly something we're watching pretty carefully. And I think that's also a reason why, from your point of view, the banks have been in a holding pattern, just because we are trying to figure out what the monetary policy path looks like going forward.
And finally, Amy, what's your outlook looking towards 2022?
Sure. As I've mentioned, I think the setup for banks going into 2022 and beyond look pretty good at this point. The Fed, as we are already knowing, they are also reducing quantitative easing program at this point. And as that happens, I believe the liquidity aspect to the financial system should begin to taper off, which is good because right now when we're looking at loan growth for many of these banks, it's been mediocre. And just to give you some context, the Q3 loan growth for some of the major banks out there has been about 1% on a year-over-year basis. And that's probably because there's so much liquidity in the system, there's no need for really taking a loan out. And so as that stimulus money and as that cash starts to dry up a little bit, we do think that's a good setup as loan growth should grow in favor of higher than 1% going into 22. And then finally, I think the balance sheet and the health of some of these banks continue to look pretty good. Many of these banks are still sitting on excess capital. We estimate that they, at least from the standpoint of some of the larger ones, are sitting on more than $60 billion of excess capital, which, again, could be used towards buybacks or dividends, assuming that the Fed allows for that, or M&A, which I think, again, could be a good setup for the banks in general. So with that in mind, I do think that the setup looks good, and we would continue to hold many of our banking stocks in our portfolios.
Amy, thank you so much. Amy Kong, Chief Investment Officer at Barrett Asset Management. Now, before I go, here are some of the top stories in this space. European Union antitrust regulators fined Barclays, Credit Suisse, HSBC and NatWest a total of $390 million for the rigging of the foreign exchange spot market. UBS avoided a fine as it had alerted the European Commission about the cartel. Barclays, HSBC and NatWest admitted wrongdoing in exchange for a reduced penalty, but HSBC still paid the largest fine of about $200 million for its involvement in the so-called Sterling Lads cartel. The Jack Dorsey-led payments company Square says it is changing its name to Block. Square says the rebrand will take place around December 10th and will allow it to expand into new technologies such as blockchain. Dorsey is expected to have more time to focus on the company after stepping down as CEO of Twitter on Monday. And finally, Australia's OpenPay Group has struck a partnership deal with American Express to allow Amex customers to fund purchases with OpenPay's Buy Now, Pay Later services. OpenPay said the initial deal would focus on 40 Amex merchants in the healthcare and automotive sectors. And that is your roundup of the US banking sector. I'm Emma McCarthy, and this is Reuters.